In this video, we're going to learn about finance. And as always, I'm going to give a shout out to the Tennessee Council of Cooperatives, our sponsors. I'm Dr. Justin Gardner with Middle Tennessee State University School of Agribusiness and Agriscience. So today's lesson on finance, we're going to cover some terminology. Keep in mind that these things we're going to learn today apply to all businesses, not just cooperatives. So think about this as a good 10-15 minute introduction to what finance is and some of the words and some of the things you might see when you talk about finance. So let's jump right into it, cover some terminology and some key documents. The first word I want you to know is revenue. Revenue is the money that you bring into a business. For example, when you sell something, the money that comes in from that sale is your revenue. If you provide a service to one of your cooperative patrons, the money they give you is your revenue. Sometimes we might see revenue referred to as sales or net sales or gross sales. Now, gross means before we back out any expenses, and net means after we back out some expenses or perhaps even all expenses depending on the type of net we're talking about. For example, the difference between net sales and gross sales. Gross sales might include sales you made but someone returned the product to you, whereas net sales would back out the product returns. The next word I want you to know is profit. And before I tell you what profit is, I want you to understand that revenue is not how much money you made. The amount of money you made is called profit. And in order to find profit, you've got to back out all of your expenses. So profit is revenue minus expenses. And this is something that's actually very important. I get into a lot of conversations with people who will tell me that they made so much money or some certain sum of money from selling a horse, a cow, a pig, a goat, or something like that. And I always ask them, oh really? What were your expenses like? And they oftentimes kind of give me this blank look where they didn't really stop and count up the cost of making that product. And I always do that because I'm not interested in revenue. I'm interested in profit, because profit is what you get to bring home from your business. For our cooperative, the profit is what you get to hand back to your member as a patronage refund, and then you'll be doing business at cost. So profit is revenue minus expenses. Take how much money you made, back out how much money you spent. That is your profit. Let's think about expenses. Expenses could be anything that you spend money on. For example, cost of goods sold, that's going to be an expense. If you're running the type of business that buys a product from a supplier and turns around and resells it like so many retail stores do, the money you spend buying from other people, that's your cost of goods sold. Labor and wages, the amount of money you spend paying people to work in your business. Taxes, that's a type of expense. Insurance. Anything you got to spend money on, utilities, you got to keep the lights on, right? Depreciation, we'll learn more about depreciation a little bit later, but depreciation is where you have an asset that loses value over time, like a car often does, or maybe you have a fence on your farm, and as the fence gets older, it decays and becomes less valuable, and that's a type of expense. Interest, very common for businesses to borrow money. And the money they spend paying interest, that's an expense. Bad debt loss. Let's say you've got a patron in your supply cooperative that showed up one day and picked some product and said, hey, I'll pay you Tuesday, and they never did. You might have to write that off as a type of expense called bad debt loss. Repair and maintenance. You have equipment that needs fixing, it needs maintaining, your delivery truck needs an oil change and it needs new tires. You're going to have repair and maintenance expenses. Materials, things that you buy in order to do business. You might call these supplies, for example. Anything that you buy, anything that you spend money on, that's going to get listed as an expense in our finance documents. Some more terminology that we need to know. Cost of goods sold and gross margin. So the cost of goods sold is very important. That is your beginning inventory minus your ending inventory plus your purchases. Now remember that these are financial documents. This is not going to be a list of all the things in inventory. This is going to be a list of what all these things are worth. So that beginning inventory number is a dollar amount. So your cost of goods sold, in other words, how much you spent on the stuff that you turned around and resold, is going to be the value of your inventory at the beginning of the time period we're studying. We call that the accounting period, minus the value of your inventory at the end of the time period we're studying, plus any money we spent buying items that we're going to turn around and resell during this time period. Gross margin is going to be sales minus cost of goods sold. Sometimes we see firms call this gross income or gross profit. The idea here is that we have gross sales, back out the cost of goods sold, that gives us our gross margin. Let's talk about inventory for a second. Inventory is a very tricky thing. The first thing you need to understand about inventory is it is a type of asset. Assets are things that you own that are going to be used to make you money. They're items of value that generate value. And when you list your inventory on your financial documents, it's listed as a dollar value. And inventory is a very specific thing. It's specifically stuff you're going to sell in order to make money as a deliberate part of your business. And this actually requires some more explanation. Inventory sounds really simple, but it's far more nuanced and complex than you thought it would be. Here are some examples of what I mean by that. Let's say you're in the business of making cabinets, and you've got plywood, and you've got screws, and maybe you have MDF or whatever it is you're making your cabinets out of. You got some 2x4s, and you've got a bunch of finished cabinets that you've made that are sitting around ready to be sold. These items are your inventory. Everything on the left-hand side of this screen, these are things that you are purchasing and using and owning for the sole purpose of turning them into something else and reselling them. Everything on your right-hand side, these are all assets, but they're not inventory. For example, if you're using a table saw to cut up your plywood, you're not going to turn around and sell that table saw, because if you sold the table saw, you'd be out of business. So your table saw cannot be counted in your inventory because it's not something you would normally want to get rid of. A drill that you might use in your business, that can't be inventory unless you're in the business of selling drills. Now, a router is a rotary tool that's used to make nice fancy designs in your cabinets. And if you sold your router, you couldn't make nice fancy designs in your cabinets and you'd be out of business. The same goes for the truck you're going to use to pick up your materials and supplies and inventory items, and then the truck you're going to use to deliver them. Without the truck, you can't do business. So the difference is here, everything on the right-hand side of the screen, these aren't things that you're in the business of selling. But our cabinet maker is in the business of taking inputs like plywood and screws and turning them into finished cabinets and selling those things. So everything on the left, that's game for inventory. Everything on the right, those are assets, but they're not inventory. Another way to think about it, these items on the right are items you're going to use for more than 1 year. These are items that will have depreciation. This takes more examples to understand, so we're going to hit another one. I keep using the word asset. Asset is something of value. Assets can be anything. They can be intellectual. They can be, ideas in your mind are assets to you. An asset is any item that a business owns or controls in order to use in the business. It can be long-term or fixed. Assets tend to be things you're going to have around for a while. Anything the business is going to use to make money can be thought of as an asset. One asset is cash. And I think cash is probably the most important asset. It's a special type of asset called a short-term asset. A short-term asset is going to be cash or anything that we plan to convert to cash during the current accounting period. And accounting period just means the time period that you're keeping your records for. It could be a year, it could be a quarter, a month, a week, whatever you want to do in your own business. Inventory is a perfect example of a short-term asset. Your plan is to turn your inventory into cash as a normal course of doing business, and that's what makes it a short-term asset. In fact, you're in the business of turning your inventory into cash. That's one reason why a tractor would not be counted as inventory, because you're not in the business of turning your tractor into cash. Now, a fixed asset is an asset we're going to use for more than one accounting period. And when I say the word accounting period, think year, right? If you're running a farm and you've got a cow-calf operation, you've got a bull and you've got some cows, that's your breeding stock. Your breeding stock is a fixed asset. You're going to hold on to the breeding stock for more than 1 year. Now, what fixed assets will do is they will depreciate. Depreciation is a decrease in the value of an asset over time due to simply using the asset. The way you want to think about it, depreciation is the gradual destruction of this asset because you need to use the asset to make money. The way I want to teach you to calculate depreciation is the single most straightforward way. We call it the straight line method. Here's what you do. You figure out what you paid for some item. That's called the purchase price. You estimate what that item is going to be worth when you're finished with it and you're ready to sell it to someone else. We call it the salvage value. And we divide that by the number of years we plan on operating the asset on our farm. Let's say we paid $100,000 for a used combine, and we're planning on using that combine for 5 years, and we think we can sell it for $50,000 when we're done. So we do 100,000 minus 50,000 on the top of our fraction here, and on the bottom of our fraction we're going to divide that by the 5 years we're going to use it. That gives us 50,000 over 5, and so that gives us $10,000 a year of annual depreciation. Any item that you have, any asset you have in your business that you're going to be using for multiple years needs to be depreciated on your financial documents. There are other methods for doing depreciation. There are accelerated depreciation schedules, but this is a class on cooperatives, or a video on cooperatives, not a full-blown finance class, so we're not going to worry about that for now. But if you'll use straight line depreciation, you'll do just fine until you get to the point where you need more, and then I'll be glad to teach anyone more about it. So profit is going to be revenue minus expenses. Now there are other names for profit, such as net income, right? There are other ways to calculate it. Sometimes we call it gross income minus expenses. So just kind of be aware when you see gross income minus expenses or the word net income, we're all talking about profit here, okay? Sometimes on our financial documents, we're going to break profit down, forgive the typo on the slide there, into other sub definitions of profit. It's very common for us to do our income minus our expenses, ignoring taxes, and get a profit figure before taxes. We call that net income before taxes. And then on the next line in our operating statement or our profit and loss statement, we might subtract the taxes to get the net income after taxes. So just kind of be aware when you're reading financial statements that it's very common to break down our profit into profit before taxes and profit after taxes. You know, that's typically done so you can calculate the taxes. Is one reason why you see that. Here's another big fancy word: liability is a liability. In a business, liability is money that you owe somebody else. When you borrow money from the bank and you need to pay it back, that's liability. Here's a fancy buzzword for you here in accounting circles a lot: accrued. Accrued means accumulated. So by the process of doing business, you're getting taxed on any money that you make. And so you can think of your taxes as something that's gradually building up through the year, or accumulating or accruing throughout the year. And when those taxes accrue, you should keep track of it so that you can be prepared to pay the tax man. There's no way to avoid the tax man. The tax man's always there. Another word you want to know is called equity. Sometimes we call this net worth on a financial document. Equity is easy to calculate. You take your assets, the things that you own that you're going to use to make money, and you subtract the liabilities. Here's what you own, here's what you owe other people. The difference between the two is your equity. Now sometimes the word equity is used in the context of an investment, so you may have equity in a cooperative. That's where you've invested in the cooperative. This is a slightly different meaning of the word equity, but at the end of the day, if you can think of the word equity meaning value, value beyond what you owe somebody, there you go. Equity is basically that. I do believe that is my last slide. It's been a particularly long video with a lot of stuff in it you may not have seen before, and I want to thank you for sticking right here with me until the bitter end. More videos will always be available for you. I've got several more I'm going to put up online for you to watch, and I sure thank you for watching my videos. Have a great day.